hello everybody. So today was going to be a morning video, but because of what's going on in the market, because of the nonsense, the noise, I ended up wasting a bunch of my day on X. This is kind of ridiculous, the tit for tat going on between T and E. You know, I gotta be careful if I name either, because I think this tit for tat is ridiculous. Poor German chancellor, that press conference was not supposed to be about a tit for tat between E and T, but it is what it is. We're moving from 3 to 4 years of madness between the Fed back and forth on the market, and now the market is moving on ridiculous things like this. So I guess E hates T now, so they don't like each other now. So does that mean that the overhang of a stock goes away? Does it mean everybody comes back? I think the main takeaway of this madness is that we have to put things into perspective. Is $100 billion money when we consider that a tit for tat on Twitter can make one of the largest market caps in the world move 11%, right? This is just tit for tat for Twitter and makes the stock move 11%. What does that tell about the US dollar? What does that tell about the value of money? I think it tells much, much more than it tells about Tesla stock. The stock doesn't change. The stock is the stock, but the movement is just crazy. And these things trade at the edge. Be very careful with options. Be very careful with all that sort of stuff, because this is crazy. Anyways, if Elon's not happy about the government spending, on this channel, as you know, it's called Beat the Denominator. I cover Bitcoin a lot on this channel. Elon, let me tell you that Bitcoin fixes that. Why don't you turn Tesla into a Bitcoin treasury company and participate in solving the issue of moving away from the US dollar, which is the only way, as evidenced by the big beautiful bill, which is just gonna, spend ever more money. QE to infinity is the only way. The escape is Bitcoin, and Elon knew that back in 2021, by the way. He's the one who initiated the major Bitcoin buy at Tesla. I think he should get back into that. And let me move on. We've discussed AI, right? Well, a little bit. The reason why I own Tesla, Tesla is my second biggest position. The reason why I own Tesla is because of real-world AI. Whether it is self-driving, whether it is Optimus, I couldn't care less about cars. I own Tesla for AI, although I do believe electric cars are a superior product to gas cars. But I own it for AI. I wish I could talk about that today. We're not talking about that. Bitcoin, I've talked a lot about Bitcoin on this channel. I think there's 3 big buckets of investing, as I've said before. You got the revolution of money, the revolution of everything we love, the revolution of the denominator. That's Bitcoin. Bitcoin is that revolution, the moving away from bonds to Bitcoin, from traditional finance to digital finance, to new finance. That whole conversation about the deficit is part of that conversation. There's the other big revolution, which is AI, and Tesla is at the heart of that AI revolution. And then there's a third revolution, which is the bucket that I invest in, which is health. Health is that bucket. And, I want to talk about health. I want to make long videos talking about the revolution that is brewing in health and the performance of these companies. There's amazing companies doing important, amazing work in the field of healthcare and solving that problem, which is, if we've solved money with Bitcoin, if we've solved intelligence with AI, the last thing we need to solve is a long, healthy life. And that's what these companies are addressing. They are, in my view, in general, healthcare, innovative healthcare, deep tech healthcare, in my view, is one of the most, underappreciated area of the market. And if you want to have any idea of how underappreciated this sector is, I suggest you look at ARKG, the ARKG ETF of Cathie Wood. The stocks I'm going to present to you are all innovative in the field of healthcare, but they're also very cheap, right? And we know, for example, Cathie Wood, she doesn't care about valuation. So she will have some of the same stocks that I have in there, but she'll have also plenty of very expensive stocks in healthcare. Me, I only focus on inexpensive stocks in healthcare because I want to protect myself in this sector that is getting no love from the market. So let's talk about healthcare. I have, 6 stocks that I want to briefly discuss today. They are doing well today, contrary to my second biggest position, who is not doing well because of a Twitter tweet storm. Let's talk about the first stock that I own, which is TGTX. TGTX is a treatment, it's a CD20 therapy. It is a treatment for a disease called multiple sclerosis, which is a very painful disease. It's not like patients can get away not treating it. This treatment is the latest and last to be approved by the FDA. The FDA will not approve any more treatment because it is the last CD20 that will be approved. They happen to be cheaper, they charge less to insurance, and they happen to have shorter injection times. And this product is patent protected until 2042. This company, forget that one-time item here, but the revenue growth has been very consistent. It's growing at 65% next 12 months revenue growth. And the valuation is an EV over GP over LG is 0.27. This stock used to be much cheaper, but it started running. And so, unfortunately, it's a little more expensive right now. Maybe it will get cheaper. I don't know. It's a little more expensive. It's starting to get some noticing in the market, but nonetheless still cheap at a 0.27. But this will be the most expensive stock I talk about today. The market loves this stock because the market loves rent seeking, and they are a cash cow. They are going to be a cash cow because there's only 3 therapies that are ever going to be approved, and this therapy for MS is actually more than $50,000. I think it's like something like $55,000 for that therapy. They have some optionality for a single product tech company. One of them is sub-Q Briumvi. So this is something this is a version of their drug, which is called Briumvi, but that version will be at home for injection at home. And then they have some optionality with myogravus, which is another disease which is somewhat related to MS, which is close to MS, and they could potentially develop a drug from their CD22 MG. But take that with a grain of salt, of course, with these companies. I like this stock very much. This is a hold for the long run for me. I think it's a great company that I own. Moving on to channel favorite, number 3 position. And I gotta be careful. If Tesla keeps dropping, HIMS might be the number 2 position. But anyways, it is HIMS. So HIMS is tough to judge HIMS with the stock price because it's a battle between the longs and the shorts. So don't let the shorts overshadow the story. HIMS is mostly a story of revenue growth for now. In fact, the revenue growth has accelerated thanks to GLP-1, but the revenue growth is about to accelerate even more with their acquisition of Zava. HIMS is what? HIMS is healthcare for minor stuff, and they will move to medium stuff soon in my view, but minor stuff, it's healthcare for minor things that is cheaper than your copays. I've done that comparison before on the channel. It's healthcare for minor things that you can access in less than 24 hours. It's customer-centric healthcare with clear pricing upfront. You know exactly upfront how much you're going to pay. You don't have to wait 3 weeks for a bill in the mail that sometimes people forget, and then they ruin their credit because they get sent to collection because they didn't catch the $12 bill that the insurance didn't cover. Anyways, it's cheaper than your copay up front. The point is what? It's better. Custom medications, televisit, you see someone under 24 hours. It's cheaper. Not only is it cheaper because you have price certainty, but it's also cheaper because the average American spends something close to $3,000 in out-of-pocket healthcare costs, and it is faster. I've said that before. Televisits make it faster. What about the valuation? The valuation for HIMS right now is pretty good at a 0.13. You may remember a while back when that growth hadn't exploded, it had reached close to a 1.19 at one point. So it's getting a little cheaper. I like that valuation for HIMS. I am loving HIMS right now. I think it's my most consensus play. Like out of all of the stocks that I own, right? MicroStrategy is controversial sometimes. Tesla is definitely controversial. This one is becoming a consensus. We are noticing this in the market. A lot of people are loving this stock now, so it's becoming a consensus. Another stock that I like very much is BioStem. So BioStem is a funny one to a lot of people leaving comments on the channel. It's the cheapest stock in the history of the channel at a 0.01, and the reason for that is because it's up nicely today. It's back to near all-time high for this one at $14. This is a stock that is still dirt cheap, though. You can look at the cheapness of it. $302 million is the revenue. The enterprise value of the company is $220 million. So and if you do forward revenue is trading at 0.41x forward revenue. So think about that. Look at forward gross profit, 0.43x. enterprise value over adjusted EBITDA is a 7. They achieve a rule of 40 at a 90, and they're trading at not a 0.1, but a 0.01. So this is 13 times cheaper than HIMSS. What do? BioStem turns placenta into band-aids and bandages and wound care dressings, as they call them. I call it bandage because I'm a YouTuber, so there you go. But anyways, they have a lot of optionality. I see. So first of all, the product, from what I understand, is very effective, much more effective for tough wounds. But they have two optionality that I see. First of all, I think they have a clear positioning in the stem cell business because they are getting these placentas. They have a process in place, and so they're getting stem cells. As stem cells get developed, I could see them have some optionality in that. I see some optionality in the muslim world because oftentimes that product is used to replace xenograft, and xenografts are mostly pork skins, and so obviously you can't have that in the muslim world. But I'm just thinking out loud here, but I think this could be optionality. The local coverage determination is the main risk for them. Every year, the Medicare, the CMMS decides who gets reimbursed and who gets not reimbursed, and that's how healthcare companies die, when they don't get reimbursed. This company went into a scare at the turn of 2025, but luck struck, and they were still in the LCD until January 2026. And so the main risk is, are they going to be in the LCD beyond 2026? Well, guess what? In my view, they have enough time to make enough cash in order to make that risk really nil, because they'll be flush with cash even if they don't have it anymore in 2026. And keep in mind that these products can still be used, right? Even if LCD is not continued, you can still be used, but you're not eligible for as much of a reimbursement, oftentimes no reimbursement, which means that you tend to be used in private clinics, which is a much more smaller subset. But they have optionality in diabetic foot ulcers. Diabetic foot ulcers is the opportunity that they've noted many times. They're going after that. That could be an enormous opportunity because it costs a lot of money to Medicare. And if their wound care dressings based with placentas, made with placentas, amniorap as they call it, if it were to work, that could be a huge sell, kind of like a Cormedics, where you would have a wound care dressing that actually reduces the cost for the healthcare system. They have a NASDAQ uplisting coming, hopefully, at some point, and that should really help the stock out too. I like BioStem very much. It is a long-term hold for me. Let's talk about Delcath. Delcath is a stock that I bought today, actually, this morning, before the whole madness of Tesla happened. Anyways, I bought it today. Delcath, I covered it on the channel before. I can't remember if it was a Patreon exclusive or if it was on the main channel right now. But anyways, Delcath, in my view, from what I understand, is sort of a breakthrough in kidney cancer care, because you see, kidney tends to be a very tough cancer to operate on, and you tend to have multiple spots whenever you have cancer in the kidney, and it's a very tough organ to operate on, and it's been unfortunate. And so hospitals seem to be loving this product, and they seem to be ramping up adoption of this product, which is called Hespado, and it's there's another product that they had to this. Anyways, the marketing for healthcare is always a little odd, I guess. But the point is, what is this system? It's a targeted chemotherapy for the liver, and it has CAF in the name because the way it works is you block access to the liver at the entrance and at the exit of the liver, and then you deliver the therapy, and then you have a filtration machine that removes all of the chemo. Chemo is poison, right? It kills cancer. It removes all of the chemo after you're done. You do this in a closed system, and in a closed loop. You just treat the liver, and as a result of that, you're much more effective because you're able to really saturate the liver with that dose of chemo, and you don't have it all spread out and be less effective. Anyways, if it's FDA approved, from what I understand, hospitals are rushing to adopt it. A lot of people are loving this product, and the revenue growth has been nothing short of outstanding. You can see the pre-FDA approval, and then you see FDA approval, and then you see this enormous ramp-up. Revenue growth has been nearly 1100% year over year, and they're predicted to go on over 300% next year. And note in my spreadsheet, I have it as 150% compared to Seeking Alpha. I was it at 300%. So you see how conservative I am, because I have no way to know how quickly this is going to grow. I don't think they have a way to know either. All I know is that when I see a stock who went up 140% in the past year, when the revenue went up, let's call it 11%. Let's round it up. Went up 1100%. So you have the revenue does a 11x. The stock does a 2.4x. To me, there's a disconnect. And that's why the stock is so cheap. I like it very much. Moving on to LifeMD. LifeMD is a stock that I've called on this channel before baby HIMSS. Kind of jokingly, but it is a baby HIMSS. It's a mini HIMSS. They have a lot of similarities with HIMSS, a few differences which make me like it just a tad less than HIMSS. I think they have great marketing though. Their LifeMD Plus offering, I would like to see that promoted more. Because you got access for doctors for $19 a month. This is literally the Netflix of the business. You pay $19 a month, and you have a doctor that you can access on call. It's really interesting in my view. I wonder how they make this profitable. I mean, they hire a lot of doctors. That's why. But anyways, RexMD is their division that they have. It's a direct, smaller competitor of HIMSS, focusing on the same men's health issues that HIMSS does. And if we know anything about HIMSS, is that this men's health segment at HIMSS is still growing, and I see no reason why this is not growing for LifeMD as well. LifeMD likes to differentiate itself by taking insurance, but in my view, as a result, it grows slower. As the CEO mentioned before, it took them an enormous amount of time to set up insurance of the back end, and in my view, that means that they grow only slower, because if you take insurance, it's going to be a much more complicated business to run. HIMSS does not take insurance, but like HIMSS, however, even though they differentiate themselves by accepting many insurances, however, they, like HIMSS, focus on highly profitable verticals. This is the business model of HIMSS. What is that business model? You take away the cash cow patient from the mom and pop doctor offices in your physical residential town, your mom and pop doctor office. The bread and butter, that bread and butter can move online. And HIMSS and LifeMD, they're capturing that bread and butter, those easy cases, as I like to call them, assuming there is such a thing, but as I like to call them, the easy cases. They just launched a pharmacy like HIMSS. In the past, they used to give coupons, kind of like GoodRx type coupons, just like a GoodRx, right? They used to send their coupons for people to get the pharmacy elsewhere, the RX elsewhere. Now a prescription, they are trying to fulfill a prescription. So they are following the vertical integration playbook of owning the pharmacy, in addition to owning the delivery of the care. They've partnered with LabCorp for labs, and as a result of their integration of labs for a long time, they have been able to treat a wider range of treatment, although that is changing for HIMSS, because HIMSS acquired Tribe. Tribe is a Lancet company which is going to allow you to do at-home labs on your own. And there has been, maybe a little bit less now, but there has been a bit of overhang on the stock because of WorkSimpli. WorkSimpli, in my view, needs to be sold. It's a business that grows slower, and it makes revenue growth look even smaller than it should look for LifeMD. Revenue growth for LifeMD is closer, is between 50 and 60%. So not quite the 110% of HIMSS, but it's still much higher than 28%. But you don't see that because they have WorkSimpli, which is a software company, which is unrelated to LifeMD, and they need to sell it off because it grows slower than LifeMD, and it makes the picture of LifeMD less clear as far as stock performance go, because they may not have the same amount of shorts than HIMSS has, or maybe they have a short squeeze earlier. I don't know. Short-term price action, I don't follow too much. But when it comes to LifeMD, you can see it's up 132% year to date. So very impressive stock performance. I've been happy to own LifeMD. And the last stock that I own in the healthcare sector is CorMedix. CorMedix is a catheter lock solution. I covered it not a long time ago, so if you know it, you may remember me covering it. I've been big on Cormedics for a while, actually. This was released on the main channel, on the Patreon channel earlier than on the main YouTube channel. But the point of CorMedix is what is it? It's a catheter lock solution. So dialysis. Let's talk about dialysis very briefly. Kidney failure. You have dialysis. You have kidney failure. What means is that you need to filter your kidneys every multiple times a week. Typically, it all depends on what the doctor chooses. But whenever you go, the treatment goes through the catheter. The filtering goes through the catheter. And if you go home and the catheter is just in the open, you could get an infection. And if you get an infection, oftentimes, unfortunately, it's fatal, unfortunately, but then it also costs a whole lot of money. When it's not, either way, it costs a lot of money to have an infection. So this is a product, it's a vial, it's a catheter lock solution. It's a solution that you put after each dialysis treatment. They open the vial and they put it into the tube, and then it locks it until your next treatment. That vial costs $250, and Medicare is happy to pay for that vial, because nothing makes it worse for Medicare than you having an infection. Because if you have an infection, it can be an $80,000 hospital bill. Medicare also incentivizes Fresnisius and Davida, the catheter center, the dialysis center. They are incentivized to have as little infections as possible by Medicare, because the more infection, the more the cost. As a result of that, this product has been growing very fast. Forward revenue growth is predicted to be 180%. And it was growing very fast too, but they've noted on the call that customer, there's two big customers in dialysis center, and one of them is taking a little longer to onboard than the other one. Essentially, is the reason why we are going to see, in my view, much more growth on the back end of the company. Anyways, I find the company pretty cheap at $13, considering the fact that analysts tell me it's still going to grow at 180%. Look at this EBITDA margin profitability, 60% EBITDA margin profitable. This stock makes a lot of money, 83% gross margin. Rule of 40 is a 240, and enterprise value over gross profit or revenue growth is a 0.07. So you can see why I say these stocks are cheap. These stocks are overlooked by the market. Why? Because it's not the most fun thing to talk about, and sometimes it's technical. So that's why I think a lot of people don't like these stocks. But nonetheless, they are, to me, in the third revolution, as far as I'm concerned, which is the revolution of health. And I like these very much. There's, a few good hundreds of innovative companies like that. Not all of them are cheap. So for me, I want to see them both very much innovative, but also very much cheap. And so that's why on this video I cover only the cheap ones, and on this channel I only cover the cheap ones. So anyways, this was not investment advice, this was not financial advice, this was not health advice, not catheter advice, no advice whatsoever. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.